So you've got this terrific report out, really going through, really surveying what's going on with hedge funds. What were the top line issues for you?
Right, so 2018, as you mentioned, was a very challenging year for the industry, and I think it was notable mainly because it was a year where we observed contraction. Overall AUM decline led by both performance and net outflows. Investors were clearly frustrated and disappointed with performance. On that point, though, I think it's important to note that while we did have outflows for 2018, they were not as a result directly of 2018 performance in isolation. We've been observing a continued trend over the last couple of years since the 15-16 drawdown, where there has been a rotation away from traditional equity strategies, so long short, equity special sits, into strategies that have provided better downside protection, higher Sharpe ratios, and more persistent evidence of alpha generation. Things like quant equity, equity market neutral, sector-focused funds, and fixed income relative value being another.
That's 2018. What do we know, if anything, about 2019? We're about a quarter of the way into the year so far. How is 2019 likely to be different from last year?
Right, so a lot of expectations for performance rebound, and thankfully, as we're close to wrapping up the first quarter, we've seen a strong rebound and rally in risk-based assets, and a notable improvement in terms of the environment being conducive to alpha generation, notably January as an example.
Something that David pointed out, we were talking about this in your report earlier, was that lower fees did not necessarily generate better returns, and we have a chart that kind of shows that dynamic. Can you walk us through how you understood that?
Yes. So every year,
walk us through this bar chart, because on the surface,
this is from your report,
right? So every year in the Barclays study, we take a look at fees, and while I thought was noticeable this year, there wasn't a discernible decrease, right? But what we're noticing and what the report showed us was that investors who paid beyond the median fees, like higher fees falling into that camp, actually had better returns. So proving the thought that you get what you pay for, and we also saw evidence of this in the survey of 2017.
Yeah, of course, there may be a chicken and egg issue there. It may be that you're willing to pay for more if you've got a performer, right?
Right. And, there I think that flows into another theme we saw in our survey, that of consolidation, and we also saw differences in performance or dispersion in performance for investors with more concentrated portfolios, and the sweet spot there was somewhere between 11 and 20 managers, right? So bolstering the case for bottoms-up manager selection rather than going for the cheapest available.
What sort of consolidation are we seeing in the industry, and how much of it is actually funds just merging and putting together, or as opposed to co-investing, going into deals together?
Right, so we're seeing kind of two worlds emerge. Larger asset owners are looking for scale and driving this theme of consolidation. We do also see the emergence of that other world of product specialists, people clearly giving a capacity constrained, differentiated return stream with the groups that have a defined, clear edge.
What regions are seeing the most activity?
Yes, so we observed strong interest in our investor universe of looking at Asia. This is an area that they indicated they're significantly underexposed and looking to change that over the coming months.